Today, we're going to pull back the curtain on the market's hidden engine. We're talking about the powerful, almost mechanical forces that move billions of dollars and often drive stock prices in ways that, let's be honest, just don't seem to make any sense. This is all about index flows. You've been there, right? A company you follow reports amazing earnings, crushes all expectations, and the stock tanks. Or maybe a stock you own just skyrockets higher for absolutely no reason you can find. It's incredibly frustrating. But what if the reason has nothing to do with news or fundamentals or what anyone thinks? What if something else is really moving the market? And that gets us to our first big idea. A huge part of the market isn't driven by emotion or some brilliant analyst's opinion. Nope, it just runs on autopilot, governed by a simple, unthinking set of rules. To really get this, you have to look at what an index, like the S&P 500, actually is. It is not a judgment on the health of the economy. It's just a machine, a rules-based portfolio. Most of them are market cap weighted, which is just a fancy way of saying the bigger the company, the bigger its slice of the pie. That's it. It's a calculator, not a think tank. So here's the key analogy you need to keep in your head. If you stop thinking of the market as this big collection of human opinions, and you start seeing it as a massive plumbing system, just a network of pipes and valves, a lot of those confusing movements suddenly start to make perfect sense. And this whole system boils down to a really simple but incredibly powerful causal chain. You've got the rules of the index. Those rules create mandatory money flows. They open and close the valves. And those flows directly, and I mean directly, impact the price of stocks. It's that simple. Rules dictate flows, and flows determine price. Okay, so let's dig into the core mechanic that drives all of this, the process of rebalancing. This is the thing that forces enormous pools of money to buy and sell, whether they want to or not. It's a forced hand. So, why does rebalancing even have to happen? Well, it's because of something called the drift problem. Think about it. When one stock's price shoots up, its weight, its slice of that index pie, gets bigger. It drifts away from its target allocation. And this creates an imbalance that, according to the rules of the index, must be corrected. This is just a brilliant illustration of how it works in the real world. Let's walk through it. Step 1. Apple has a fantastic run. It's up 30%. Great. Step 2. Well, because of that, its weight in the index automatically gets too big. Now, for step 3, all those passive funds that are built to perfectly mirror the index are suddenly overweight Apple. And here's the most important part. Step 4. The rule says they must sell the winner, Apple, and use that money to buy the stocks that lagged behind just to get back in balance. This isn't a choice, it's a forced trade. Now, this forced trading tends to happen in a few key ways. First, you've got the big scheduled rebalances, like the annual Russell reconstitution. These are known months in advance, and because they're so predictable, hedge funds and other pros try to trade ahead of them, causing these massive spikes in volume right at the market close. Then you have additions and deletions. When a company, say, gets added to the S&P 500, every single index fund out there has to buy it. This creates a huge wave of demand that has nothing to do with valuation, and it often just fades away right after the inclusion date. But there's a third type, a hidden one, that's always working in the background: continuous rebalancing. Every single day, funds are making these tiny little adjustments, and this creates this subtle but incredibly powerful effect. It's like a hidden gravity that's constantly trimming the wings of high-flying, volatile stocks while feeding slow, steady trickles of cash to the more stable ones. So what are the bigger consequences of all this? Well, it means that sometimes, and actually pretty often in the short term, these mechanical flows can completely overpower traditional analysis of a company. They can trump fundamentals. The money that's moving through these pipes comes from a few massive sources. You've got your passive inflows. Just think of your monthly 401k or pension contribution. That money automatically goes out and buys the biggest stocks, which just reinforces the winners. Then you have active reallocations. This is when big funds decide to sell an entire sector, maybe because of rising rates. They sell everything, punishing the good and bad companies alike. And then there's ETF creation. If a ton of people suddenly want to buy a tech ETF, well, the fund has to go out and buy all the underlying tech stocks. It's pure plumbing with zero regard for valuation. And this whole system creates a pretty major risk because these passive flows just keep feeding the winners. The biggest stocks just keep getting bigger and bigger, creating this immense concentration at the top. You can get to a point where the top 5 stocks make up nearly a third of the entire S&P 500. And what that means is the index can be hitting all-time highs while the vast majority of the stocks in it are actually going down.
The market isn't strong, just a handful of giants are.
So here's a really useful way to think about when this stuff matters most. Over the long run, we're talking years. Earnings and cash flow, fundamentals, they absolutely win. But in the short term, over days and weeks, the dominant force is often just these flows and rebalances. The market's plumbing can keep things irrational way longer than you might think. Okay, so this brings us to the final and maybe the most important piece of the puzzle. How do the pros, the institutional traders, use all this knowledge to their advantage? What's their playbook? Look, institutional traders aren't just sitting around asking, is this a good company? They're running a totally different checklist. They're asking things like, where is the money being forced to go? Who are the forced buyers and who are the forced sellers? When are the rebalance states? They're trying to figure out if a price move is driven by real information or if it's just a temporary distortion caused by the plumbing. And that really leads us to the ultimate takeaway here. You've got to forget the old idea that markets are a voting machine, carefully weighing the merits of every company every single day. In the short term, that's just not true. They're flow machines, driven by the mechanical pressures of who must trade, not who wants to trade. And that is the key thing to remember. Indexes don't have opinions. They don't care about your story, they don't care about your narrative, and they definitely don't care if a stock is cheap or expensive. They are simple machines that execute a set of rules relentlessly and automatically. And understanding those rules is the real key. So, the next time you see a stock move in a way that just makes no sense, I want you to pause and ask yourself, could this just be the plumbing at work? Now that you can see the market's hidden engine, what new patterns are you going to start to notice?